Hi, and welcome along to this mortgage lending environment update. Over the past 5 years, mortgage advisors reporting banks being willing to advance mortgage funds has averaged a miserable 7%. But currently, over 30% of mortgage advisors are reporting banks being willing to advance funds, which is awesome and quite a turnaround. New Zealand economist guru Tony Alexander said that factor is one of several indicators suggesting economic and housing conditions may be firming. Yay. Hi, I'm Kathy Frey and I'm a real estate salesperson with First National Roper and Jones based in Dargaville, and welcome to this short overview of the current mortgage marketplace. Over the past 5 years, the average percentage of mortgage refinancing applications has typically sat at about 20% of all mortgage loan applications. But for the last couple of months, it has been around 30%, which is likely because of the amount of floating interest rate loans changing to fixed interest rate loans. NZA report that 1 year fixed term mortgage lending is surging in popularity, with nearly 80% of borrowers strongly favouring short fixed 1 year terms, which is up from just about over 40% in August, and that's up from only 1/3 or around 33% in July, when floating rates were especially popular at that point. Good Returns agreed, reporting that mortgage borrowers drop short-term fixes and flock to 1 year rates. A 1 year fixed-term mortgage is a flavour of the month for the new mortgage borrowers, a sign mortgage holders believe rates have further to fall. Interesting. David Windler of the Mortgage Supply Company adds to that commentary, saying that borrowers are hedging bets. Many are mixing floating and fixed rates, while record numbers are switching banks for cashback offers. Calvin Davidson, chief economist at Cotality New Zealand, agrees, saying mortgage switching has become a defining feature of the market. Jeff Royal of iLender reminds too about the two other fund strategies most borrowers don't even know exist, being firstly revolving credit facilities, which operates like a large overdraft that you're only paying interest on with the actual money that's borrowed at any one time. So that option is often ideal for borrowers who have fluctuating expenses and income, such as freelancers and business owners. And conversely, secondly, the offset credit facility, which is when you have a credit directly linked to your savings account, so that your mortgage amount, including potentially your kids' savings accounts too, can be overall reduced in the mortgage interest that you pay. Second tier lenders, used a lot by borrowers who fall outside regular bank mortgage lending criteria, for example, those with much lower deposits or irregular self-employed income or some poor credit ratings or some non-standard property that they're buying. They're sort of outside the square with their portfolio. They have also, those second tier non-bank banks have also dropped their interest rates a lot, with companies such as Base Corp saying they're expecting their rates to reach as low as 6% at the bottom of the current cycle, which is a huge shift in the cost of non-bank finance. And they are commenting on seeing the surging mortgage volume, showing more market recovery too. Also worth pointing out that in recent months, the number of new listings has not been keeping up with the number of property sales. So the feeling of competition has been picking up a bit too, which can be why getting your mortgage finance pre-approval sorted before starting to look to buy can be more important than ever, due to the spring buying rush through to Christmas, likely to slow down bank turnaround times of processing loan applications. As Windler says, getting your pre-approval sorted puts you a step ahead and ready to act when the right property comes along. And a side reminder is that the current chasing the lowest mortgage interest rate sort of buyer lender behaviour for short duration trends, it's all sort of good to bear in mind that tactic doesn't give longer term protection against unforeseen increasing interest rates. And with the average interest rate over the past couple of decades being between 6% and 7%, it does remind me of a very savvy, experienced investor once commenting to my husband and I, "If I can get 5% or less, I'll take it for the longest term possible. Ideally 10 years if I can get it," he said. But of course, I'm not a qualified financial advisor, so do always check with your own personal mortgage broker as to what is the best finance structure for you in your individual circumstances. Finally, a reminder that our Central Reserve Bank is due to announce the next OCR, or official cash rate, on Wednesday, the 8th of October, with economists expecting another subsequent easing of mortgage interest rates, which is good news. Okay, bye everybody. Wish you a wonderful rest of your week.